Oh, hey there, everybody. So, I'm going to talk about what to do in bull markets and bear markets. Kind of a longer term view on things that I normally talk about when it comes to trading or investing. But it is actually a very relevant topic, especially considering the bull market that we are currently in. Now, you'll often hear the expression that any dummy can make money in a bull market. But the fact is, that's actually not true. More people get wrecked trading or even investing in a bull market than in a bear market. And the simple reason for that is the jubilation, the overexuberance, the FOMO nature of a bull market is to buy in when prices have already gone up. And that is problematic because people don't know when they should be actually looking at making their entries, let alone their exits. And so the problem is people tend to buy when the volatility has driven the returns up so much that the price action has gone up quite a bit, and they tend to get in late, so they buy at or near the top, and then their investments immediately start to go down, right? Or their trading positions immediately start to go down, and then they panic, and when they're already in a loss, because it usually happens pretty quickly, they sell. Sometimes they sell near where they got in, but with a small loss. Sometimes they sell at the bottom, which is like the worst possible place to sell, right? So a lot of that has to do with the fact that people are just emotionally attached to their trades or their investments. They invest in things they really care about, or they trade things they really care about. And that is a problem. And that is why we always say in alpha trading, do not be emotionally attached to your trades. That is the only thing you need to know about trading psychology or investment psychology. And that's it. Why? Because if you make investments in things you care about emotionally, if you trade things you care about emotionally, you are almost without fail going to make the wrong decisions about when you should enter and exit the markets. And people who are long-term investors will tell you, well, the easiest way to make money is just to buy and hold and buy and hold and buy and hold over time so that your returns can grow over time. Because, if you hold for 10 years or 20 years, the probability is that the market will go up and you will make money. And that has been true, pretty much since the stock market began in the U.S. and remains to be the case, as well as by the way, other stock markets as well. If you invest in things long term and you have a long term outlook of 10, 20, 30, 40 years, whatever it might be, maybe even longer if you start young enough, that you will generally get a good amount of returns from your investments. For example, if you put in $10,000 over the past 20 years, you'd have made some significant amount of gains, etc. So, and of course, investors will tell you should just hold because you don't know how to time the markets. You can't time the markets, and therefore the best thing to do is just hold and just buy every regular period for you, whether it's daily, weekly, monthly, quarterly, yearly. Just buy on a regular basis without fail. And that way you can take advantage of the overall average of the price as it moves. Well, there's a problem with that, and that problem is that price is random. Price just follows the returns. Like the price action is determined by the volatility and the correlation, and the returns are what move away from the mean and what mean revert. The price action does not. The price action just follows the returns effectively. Now, does it follow it every single candle on every single time frame? No. But does it generally follow it? Yes. Do you know why it doesn't follow it? A lot of different reasons, and one key reason is geometric Brownian motion, also known as randomness. Okay? And also probabilities. There are outliers. There are exceptions to the norm in distributions, both normal distributions and Laplace distributions. And that means that you can't just think that every single candle is going to do exactly what the returns are doing, because price action follows those returns most of the time, but occasionally does not. And that's why, although dollar cost averaging has been shown to be a relatively successful investment method, it is by far not the best in terms of optimized investing. If you actually want to maximize your returns, you should do more than just dollar cost average, but only if you know what you're doing. And that means knowing how to read the volatility, the entropy, the probability, and the statistics. And nobody who teaches or talks about investing will actually tell you this stuff, because they'll just give you big picture views of bear markets and bull markets have these characteristics, and generally you should just buy and hold. Okay, that's all good and well, especially if you have a lot of money. But if you're an average person and you have a relatively modest amount in your investment accounts, that's not really good advice. You will not make the most of your returns doing that. If you know when to enter and you know when to exit, then you'll be in better shape compared to if you just know buy and hold. There's a problem when it comes to things like Bitcoin or other assets that are very volatile, or even stocks, right? When you have the end of a bull market and it begins to become a bear market, or it begins to head towards a bear market, it heads towards the initial correction, it heads towards significant move down, and then a bear market, and then sometimes there's a major crash, sometimes there's a catastrophic kind of crash, but the problem is that a lot of investors will tell you just buy and hold, and who cares if the market goes down 30%, it'll bounce back within another year or two, and then you'll get significant gains. Okay, so then the question is, why would you want to hold an asset if you know its value is going to drop for about a year? All right? It doesn't mean you have to get the exact top on when to sell, but you should certainly sell before the major destruction is in. Right? Why? Well, because that way you'll have more capital with which to invest when it finds its bottom, or you'll just have more cash on hand to use during the bear market. Right? The point is, if you just buy and hold, and you buy and hold while it's falling in price, and you can lose in price early. And so, despite what analysts or investors may tell you, information may tell you, it is in fact not in your best interest, short term and medium term, to just buy and hold. It's in your best interest to maximize your long-term wins by knowing how to trade or invest in the short term and medium term. And to do that, again, what you should do is learn or invest using volatility, entropy, probability, and statistics. Because after all, those are the ingredients for making the most of your returns on investment. All right. Happy trading and investing. I'll talk to you later.